From the news capital of the world, you've landed where? Here on the Daily Objective from the Ayn Rand Center UK. We're delighted you're here. I'm delighted you're here because you're on history's largest daily network of programming inspired by Ayn Rand's objectivism from some of the biggest names in objectivism. We bring you everyone from James Valiant, Harry Binswanger, Dr. Peikoff, of course, has been on this channel, and the gentleman who's joining me today, Keith Weiner. He is CEO at Monetary Metals, a longtime objectivist, a studied historian of economics and so much else when it comes to money and your finances. So Keith, thank you so much for joining us today again on the Daily Objective.
Thank you, and I'm honored to be mentioned in such august company.
Well, we are all students of objectivism, and that's part of the fun of what we do here. I know you're a viewer and a subscriber to the channel. I mean, every day we're learning and we're learning more, and we're expanding our understanding of the whole world, living this exciting, life-affirming philosophy. And one of the venues, here on the channel, we talk about aesthetics. Mark Pellegrino talks about movies. We've got all types of metaphysics. So one of the things we're talking about, obviously, is economics. That is among your many fortes, that is among your fortes. So we're going to get into this issue of short selling today, what it means to not only our viewers and our listeners around the world, but what it means to their money in the markets and ultimately regulators, this is really heading up. Let's just start briefly there. I mean, for people who don't know, when we talk about short selling, when we say investment, most people are usually, well, I'm going to make an investment. I'm going to buy this stock. Short selling is just the opposite. I mean, obviously I'm right, Keith, is that this is essentially anticipating that a price will decline. You're borrowing a security and then you're selling it short first, hoping in effect you'll buy it later at a lower price and make that difference.
That's it.
Yeah. And it sounds pretty simple, but it has been hated, I think you can say, for many, many years. Here's just some of the recent headlines. How evil are short sellers? How's that for like a characterization?
I'm just reading, are they really evil or do they play about it?
Yeah. I mean, are they really evil? So just like the assumption. And even among, seemingly developed countries, I mean, Keith, you followed this. It's like just a couple of years ago, China was blaming what on its falling economy and its stock market, not their policies, but the short sellers. So this is something we've seen over and over again. The Atlantic.
That reminds me of some like Latin American banana republic dictator, blaming the woes of like why people are starving in his country and blames it on capitalist imperialists. Mm-hmm. And it's like, really?
We'll get into a little bit of the reason why, but just kind of establishing that this notion that short selling, basically anticipating something is going to go down, I mean, one question I always ask is if everyone's just buying, who's selling it to them, right? It's like if everyone's just buying, someone's got to sell it. But, is it, as one objectivist described to us here at the Daily Objective, one objectivist said, well, that's just malevolent. You're betting against a company. How is that moral? I mean, part of all these headlines are saying basically it's not just bad business, it's evil. So how is it, let me play devil's advocate, Keith, how is it not evil to bet against a company, try to make its shares go down?
I almost want to say, imagine you're at the craps table and you're the guy who puts the bet on do not pass. And then everyone's like, ooh, and they're not sure whether they want to shun you or hate you, or obviously the security guards there, so they're not going to punch you in the face, but you're the bad guy, right? The other analogy I have is, you talk about history of markets. When in England, the first stock exchange developed out of the coffee houses, and everybody who was interested in buying, the East India Company or whatever would line up on one side, and everybody who had shares to sell would line up on the other, in ranked order of their bid or their offer. And then fairly early in the development of this market, the people would kind of stand in the middle, and I think they were called jobbers, basically market makers, and they stood ready to buy or sell. And you can just imagine these very proper English gentlemen. Well, that's dodgy, isn't it? Look at him. He's buying or selling. What's wrong with that? And of course, all the calls to make it illegal and regulated. I don't know, regulated in those days, but It was something that wasn't understood, and it just seemed to be going against, if you wanted to sell shares at 100, and then this jobber stands essentially in the middle and he says, I'm happy to sell at 98. Meanwhile, you want to buy at 90, and he's standing in front of you saying, I'm happy to buy at 92. Well, the guy who wanted to buy at 90 is pissed that now somebody's outbidding him, and the guy who wanted to sell at 100 is pissed that somebody's under offering him. Everyone else should be looking at this and saying the bid-ask spread, which had been this wide, has now narrowed. And then the next jobber would come in and the next. And so the spread is set by the marginal market maker. This is how I studied economics anyways.
You're alluding to something that Dr. Brooke, Yaron Brooke, has talked about quite frequently, that, the benefit of financial markets, organized financial markets, are people can't see it. You can't see it as easy as like, hey, I got my iPhone here. It's something that people can't see up until the point, for example, like they want to sell their house, right? And gee, wish I had more bidders, or I'd like to buy something online. Gee, wish I had more offers. So,
Right.
that notion of the value of liquidity to a marketplace and how you even get that seems lost, and not only just on everyday people, Keith. This is a headline from, I want to say maybe Duke University, advocating for not only banning short selling, but win during a crisis. So this is a popular idea, even in like mainstream academia.
There's something else going on there too, which is and I'm going to call them the dirigistes, but I guess that encompasses, but it's a French word for the central planners, the technocrats. But also, obviously, Jamie Dimon now recently said that at least in bank stocks, there should be a ban on short selling. Mm-hmm. I don't know if he opined, if you want to short sell Robinhood, I don't know that he would necessarily, he'd probably be laughing. But for bank shares, you shouldn't be allowed to. And these people, they believe a lot of things, but they believe that, was it Cass Sunstein, the guy who worked for Obama trying to sell Obamacare, said, you have to nudge people. They feel like, imagine you have the scales, and that they can just push their thumb on whichever side they want to, influence and get behavior to change. Now, when it comes to financial markets, you obviously have millions and millions of people who can form an independent judgment as to what something's worth. And that's number one. Number two, the very fact that the government is trying to nudge it is definitely a signal. Now, some people say, don't fight the Fed, don't fight the nudger, go along with that because this is the outcome the government wants. But there's also a lot of other people that are like, okay, if the government's trying to force this outcome and the share price is X, despite or taking into account the effect that the government has had in lifting it by prohibiting this and nudging this and subsidizing whatever, things must be really, really bad. And so they think that they can, if I'll state it I'm going to state it in a very sort of brutally direct way to show the obvious contradiction in it. And the idea would be that you could hold the price of something to multiples of what it should be for years or decades. And as soon as you examine that premise, you're like, there's no way. Mm-hmm. If you think of water and there's some mountain pool and there's a little basin or whatever, but there's little cracks in the rock, right? And eventually it seeps, it finds its way out. You're not going to be able to hold that forever. And I think the same thing is true with the price of a share. If the government's like, well, we want this bank stock to be trading at 50, and then meanwhile, the price is just sagging in the market because everyone knows the bank's unsound, it's upside down, has duration mismatch or whatever. You can try to nudge things, say, well, we're going to ban short selling. That isn't really going to actually have the effect that you expect.
And what's the point of a market if it's not conveying accurate information? Isn't the whole point of a market to have reality reflected, to have a real-time assessment of whatever so once the government starts intervening, as you said, and ironically, they only want to always nudge it in political directions, right? Kind of, in fact, during 2008, the last time they banned short selling, you might remember it was all banks, but then they put GM on the list. They put a few other kind of favored stocks on the list, which of course shot up dramatically for a short period of time. So, the fact that this was even suggested, and as Keith just alluded to it, here's some of the headlines just recently. They're looking in, as Keith said, and as Jamie Dimon said, Jamie Dimon wants them to, once again, ban short selling. And I think if you continue to see these bank stocks decline, you'll probably see that. But let me play devil's advocate for a minute. What about people who say, Keith, look, you've just got speculators, right? They don't do anything, unfairly pushing down the price of a stock, hoping that they hurt a company. Why is that fair?
Well, sister, first of all, unfair by what standard, or fair by what standard? I mean, if you're going to float your shares in the public market, then you do understand. I mean, Monetary Metals, we think about it. We're not a public company. We're not going to be a public company tomorrow or anything, but we do think about it. What, as a company grows, what's the logical progression if you don't get taken out by acquisition? There's a point in your growth where it's logical to become a public company for a lot of reasons. And with that comes, everybody's got a different opinion. I mean, there's people who love you, there's people who hate you, there's people that are making directional bets. Sometimes they love you, sometimes they hate you. And that's just life. That's not unfair. In the same way, that's not unfair if you just walk in and say, you walk up to Hollywood and say, I want to apply to be the leading man in this action movie. And they're like, Keith, you're overweight, you're 56 years old, not going to happen. It's not unfair. That's just life. There's things I'm suited for, there's things I'm not suited for, and that life goes on. Is one issue. Now, the other, just purely at a mechanical level, right? So I find myself as an objectivist. The objectivist community always wants to push to hear the moral dimension of it, which you're talking about. The economics and finance community always, they're like, screw that, I just want to hear about the mechanics of it. Well, mechanically, let's say something truly is unsound, like GM in 2008, bankrupter than bankrupt, right? And the share price is falling. Who represents the buyer during a free fall? And if the shares have been widely shorted, then all the people who shorted it are the bidder. You're getting out, obviously at a profit, but that's going to slow its descent. If you didn't allow any short selling to begin with, what you find is the market goes literally no bid, and
it goes to zero.
Could go to zero, right?
Yeah, I mean, I love you saying that, and this is the type of thing. I started on the floor. I've been in markets, as you know, for a long time. That the outside, I mean, Miss Rand at one point talks about the so-called soaking the rich, and how she might say, the housewife only sees, the rich guy with the cufflinks. And, when we talk about speculators, they only see Steve Cohen owning the Mets and driving around, but, they don't see the immense benefit of all of these independent decisions that people are making, produced in an efficient price. As you said, that on the way down, when you want to sell, it's going to be likely a short seller who's buying from you at that lower price.
And particularly, I emphasize bid. So, retail people come in and they just take the market price. So if they want to buy it, they just put on a market order, buy 100 shares of Apple or GM or whatever. And they don't really think about the mechanics of that. Well, who is the seller? It's somebody who put in an offer. It's not another retail person who's selling. That retail person who's selling hit someone else's bid. So the two retail people aren't really crossing their trades, but there's a market maker. There's somebody who's put in a bid at a certain level or an offer at a certain level. And there's real economic calculus that goes into what level, right? So if you shorted it, you obviously have done, and short sellers are generally more sophisticated than retail. You kind of have to be. It's a hard game to play. You have unlimited downside risk, limited upside. It's a game for more sophisticated players generally. They've done their analysis. They've looked at the balance sheet. They've done a whole bunch of things, and they're like, let's say it's 100 and they're shorting it. They're like, when this thing gets to 40, that's where my bid's going to be. I wouldn't want to short it after 40. I mean, sure, it could go to 20, who knows? But at that point, you're getting into some fundamental value there. I don't want to be there as a short. And so they're putting an actual bid in. It's not an order to buy, it's a bid. And if there are no short sellers, there are no bids. And then someone says, I want to sell. If there literally isn't a bid, you can't sell, or someone puts in a stink at zero or maybe even negative, who knows? And people are going to be pissed off. And then the regulators say you have to reverse all the trades for the 17 seconds before this time when all those aren't legitimate trades or whatever. So you need that at a mechanical level, you need that short seller as the bid when it finally goes into free fall, which if the company is unsound, it will be in free fall, whether you ban short selling or not.
Well, let me, again, a little bit of devil's advocate here. I mean, what about people who say, okay, the company should be at 15, but it's at 60. So what's the big deal? If it means people won't lose their jobs, if it means people won't lose their money, what's the problem with just the stop being 60? If we get rid of the short sellers, the stock can stay up at a higher price than otherwise. Who hurts? Who's hurt in that situation? People can say, oh, the short sellers make money, everyone else loses, but what benefit is there of short sellers pushing down a stock?
I mean, the first argument that I made is that it isn't actually going to stay there despite your best nudges. And in fact, the farther from reality you want to hold it and the longer you want to hold it, it requires exponentially increasing nudge. It's not a steady state nudge. You actually have to push more and more and harder to keep it there. And the longer you fight reality, the more reality will fight harder and harder to get its revenge in the end. You won't actually be successful anyways. But that's one argument.
I don't want to interrupt, but is that quickly basically what happened with Fannie and Freddie? Is that eventually it just had to be assumed into the government because these massive organizations were subsidized by government for so long, and ultimately they had to just be assumed into the parasite had to be assumed into the mother?
That's right. I mean, the scheme grows and grows with the subsidy, which is a perverse incentive or a moral hazard, and there's all sorts of other things going on. It gets bigger and bigger, and at some point you either shut it down or onboard it to the government, which is very worrying because in the end, the government itself only has finite capacity, just a lot bigger than what Fannie had. But anyways, that was one argument. But now we're talking about what's wrong with the price. And there's actually two sub-questions to that. What's wrong with the price being too high as a level? And then what's wrong with the price only ever going upwards as a trend or as a velocity? So there's a distance and then there's a velocity. So if the price level is too high, that means that company is being allocated too much capital. Something that's very frustrating to startup founders and even companies. Monetary Metals is by no means a startup at this point, but you'd have to call us early stage, certainly compared to any major corporation. And you want to raise as much money as possible. There's so much opportunity, so many things to do, but you only merit a certain amount of capital at a time. And the way free markets work, not centrally planned, dirigiste, top down, economic commissar, national industrial policy, whatever you want to call it. But in actual free markets, is you earn that right to get that capital day by day, continuously, by what you do and by what you don't do. And if you're hitting milestones and if you're honest, then you're always earning the ability, you're earning the right and the capacity to get more capital. And then if you make mistakes, either honestly or otherwise, in free markets, that ability, that capacity to raise capital is stripped from you very quickly. And the more that government interferes, the more that it tends to bolster, the capital raising capacity of entities that have demonstrated they aren't worthy of it. So if you should be a $15 stock and you're a $60 stock, that's giving you capacity to raise capital. And who knows, you might be America Online, a relatively early stage, dial-up internet provider sending free CDs to everybody, if you remember that, in the mid to late 90s. And then you say, we're going to buy Time Warner. And everybody's looking at that, including, I think, if I remember reading about it, the CEO of Time Warner is like, are you guys nuts? But they throw so much money at it because they had so much capacity to raise so much money, because that was the insane years. I don't remember what year that deal was done, but there was so much insane, valuation because of monetary policy ultimately. So I want to put a finger on monetary policy and get back to that, because a lot of what is blamed on speculators really ultimately should go back to monetary policy. But anyways, there's in no rational world.
Let me jump in quickly, just 1 second. I mean, people see you mentioned that the short sellers are generally sophisticated. So people see them, making a lot of money once in a while. but they don't see the fact that oftentimes short sellers lose money, and as you alluded to, can lose unlimited amounts of money. But it's like everyone has so much rahmanis for when investors lose money on the way down. No one has any tears for short sellers who lose money when it moves against them.
That's right. And remember the meme stocks a couple of years ago during COVID. You have a dying movie theater chain, a dying video game retailer, one or two others. These are bad industries, and these are bad businesses in a bad industry during a bad macroeconomic environment for those bad industries, and they get shorted. And then suddenly you get all these retail people on Robinhood in particular chatting on Wall Street Bets on Reddit and say, yeah, we can make those shares go up to whatever price. And you in, bro, I'm in. And then all of a sudden, all these people are taking their COVID stimulus checks, buying the shares for the perverse. You want to talk about nihilism and malevolence, just for the perverse schadenfreude of hurting, the Carl Icahns of the world. I don't know if he was short any of those, shares.
Yeah.
But, just shorting, hurting Wall Street as they imagined they were doing, and fighting the man and whatever.
I was just saying, and most of those stocks, to my knowledge, are right back where they were before all the Wall Street Bets crowd, in effect, tried to bully them up. The same thing in the 2008. The government banned short selling. All the banks shot up 50-60%. 2, 3, 4 weeks later, they were right back where reality said they should be, where rational individuals placing their own money said they should be. So, I always feel like people can maybe impact a stock for a couple of days, even maybe a couple of weeks if they're a big player, but ultimately reality reasserts itself one way or the other.
Yeah, that's right. If you say, okay, I'm a billionaire and I'm going to go bid up, and very famously or infamously in the precious metals world, the Hunt brothers in the late 70s through 1980 decided that they knew how much silver there was. They were totally wrong about that. And decided that they could single-handedly corner the silver market. And what happened was, as the price shot up, they were buried under a deluge of more and more and more silver that came to market at those prices. It wasn't available for sale at $10 or $20, but at $50, it was raining silver. And so yeah, even if you're a billionaire, you get bankrupted unless you think you have the resources of government. And so that there's something people need to understand about this, which is, if you merit a $15 share price, and when I say you, meaning a company and management team, ultimately, sometimes changing the management team, right? So Steve Ballmer becomes CEO of Microsoft and was holding the value of the company down. When eventually they announced he's leaving, there was a boost in the share price because they said it's time for a new vision and a new leader. He was a great right-hand man to Bill Gates, but a terrible visionary, CEO. But if you aggregate company / market / business opportunity / management team merit a $15 share price, and you get a $60 share price, then you're economics teaches that resources are precious and scarce, and you're given too much. And this gets into, Bastiat talks about the seen versus the unseen. Well, the seen is that this company has a great share price and the employees are getting bonuses and all that's wonderful. The unseen is whoever else isn't getting that capital, whoever else isn't hiring those employees to do something more productive, and you're propping up something that's a dying industry. So take retailing video games. At this point, that market has moved online, with platforms like Steam and obviously Nintendo, Sony. Everybody has their own online platform. And so the idea that you would have to go to a store and buy a box with shrink wrap, and there's a piece of plastic inside, which is a disk or whatever, or some computer chips in it, that's very obsolete. And to prop that up, the sooner that all the resources that company commands are actually forfeit to other industries and other businesses that are doing something that is creating greater value, then the sooner that society gets wealthier. And so there's a, do you want society to always be ascending and getting wealthier, or do you want the pseudo wealth? Are you really getting wealthier if you own something that's failing, but its share price is going up? There's a, what was the term? And actually, was it John Kenneth Galbraith he used the term the bezel, as in a noun version of embezzlement, that there's a difference sometimes between the, sort of true value, and that's a very problematic term economically, but if something's worth here, and because of, let's say, government policy and subsidies and monetary policy, its market price is here. The delta between the two, he calls the bezel. And eventually the bezel is going to be returned, and anybody who bought it over here is obviously going to lose their shirt.
There's a notion, I think, that for some reason the shorts, because they are sophisticated, can have, if they want, a kind of a destabilizing impact, that if they kind of get together and collude, this is that supposition that if they get together, they could unfairly push a stock price down. And in my experience, just as you said, from the kind of the practical, not even the moral side, if the company is worth $50 a share, you might be able to push it down 50 cents for a day or two, but it's going to be worth 50 or even 60 or 70. No one is bigger than the market writ large, and no one is able to control it, even the most sophisticated of short sellers.
Well, I was going to say, and to add to that, if you take a look at what happened on Reddit with Wall Street Bets, but also Wall Street Silver, there's a number of these things. They're all like, yeah, man, bro, we're blood brothers forever. We're loyal forever. None of us are going to sell. And of course, there's no loyalty in an internet mob. Well, you get a bunch of people that are saying, we're going to collude. We're going to do this. We're going to bring them down to zero. And then the share price drops $10. And the guy who started it, who's promising everybody, I would never reach, break the faith here, it goes from 50 to 40, and that guy's out. And still cheering everyone else on maybe, but he's out. And I think, just even at a mechanical level, there's no way for that collusion to occur.
I want to thank Free Trade, by the way, for generous Singaporean dollar donations. We appreciate that. We're domiciled in the UK, but we are a global group of students of objectivism, learning every day, as we said, from some of the greatest minds in objectivism. And this idea, Keith, of just the morality of finance seems to come back over and over again with kind of everything in this model. I mean, it's like, even with talk of deregulation in various areas of the economy, it's never in finance. There's only a new coat of paint over and over again. And after 2008, they instituted these circuit breakers in stocks, or like stocks are now only allowed to fall by a certain amount of time. And I don't know, put your prediction cap on, or one of your prediction caps up. It seems almost inevitable that there's going to be another level of, regulation of these financial markets, more expense to our viewers ultimately, but ultimately maybe nationalization. I've seen libertarians saying, look, why don't we just have a government bank, let them make the decisions, and we don't have to have all this trading and value destruction.
Yeah, there is definitely a view. And so I use the term the otherwise free marketers. These are people that can tell you what's wrong with the minimum wage, why rent control is going to make your cities blighted, what's the problem with tariffs and national industrial policy and all these things. But when it comes to money, they believe in a fiat currency and a central bank. George Selgin comes to mind. He actually spoke at OCON. I have very few regrets in my life, but one of them, at OCON, he said, you can build a free banking system on top of a base of fiat money in a central bank. And one of my few regrets in life is that I didn't stand up, and I can have a very boomy sort of baritone, almost border tenor voice, and heckle in the finest tradition of English orators. Sir, that is not, anyways, I didn't do that. And I regret it to this day, but there's definitely one contingency amongst those that are, and there's a progression of thought. So one idea is a narrow bank. And I have an article forthcoming talking about this idea of a narrow bank versus, an actual Fed account. The Fed is talking about, would they issue a central bank digital currency, which would effectively be everyone would have a bank account at the Fed. And that's the final step, right? It's just full on, communism, right? Just to socialize the whole thing.
We could just cut out the speculators, cut out the money changers.
Well, but cut out, and this, what they're trying to do is they're trying to cut out all the market risk. And they're saying, look, the fact that Silicon Valley Bank failed, which was considered to be sound by both regulators and the ratings agencies, up until 2 days prior to its failure, was it Fitch or is it Moody's? I don't remember who's the ratings agency, and the California regulator both said the bank was sound. And 2 days later, the regulators had to take it down. And so what, and it goes back to Glass-Steagall, you have to have regulation to separate this from that. And people have lost the history of what, what a currency issuing or demand deposit taking bank used to be, is they would take in deposits of gold and put those gold out, obviously in investments that yielded a return, but they weren't buying like 10-year bonds. They were buying bills of exchange, which had short maturity and very low risk. And it's the short maturity, which is really the issue here. Silicon Valley Bank, it wasn't a credit problem. It wasn't like they lent to dodgy, sketchy borrowers. They lent to the US government, but it was 10-year bonds. And when the interest rate rises, the bond price and the interest rate are a seesaw, right? So bond price going down, and suddenly their portfolio isn't, it isn't worth, the asset is less than liability, right? They're insolvent. So, I'm sorry.
No, please.
So there are a lot of people saying, well, why do we have banks that are allowed to do this? Why don't we just have, quote unquote, a narrow bank, which is something that's been very, chic in, certain circles of otherwise free marketers, of it would be regulated to just take deposits, provide sort of, checking account, debit card, payment services kind of stuff. And it would put all of its money into treasury bills, like really short duration bills. And I'm thinking, wow, we've really come full circle. In the 19th century, they were putting it into bills of exchange, which finance trade specifically, like imports of wheat and other, urgent things. And now, 100 and something years later, it's just feed the maw of the government welfare state. And that's now deemed to be, chic and among sound money circles. And then, of course, the final step is people are going to say, why should we tolerate an entrepreneur to make a profit on this public service? Why shouldn't we just have the Fed open up, a similar account? And of course, the Fed is financing the Treasury directly, to have everybody feed their savings to the maw of the Fed. And then the Fed will feed it to the Treasury. And, you see those voices saying, rah, 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 yeah, let's do this. And you're like, you don't understand. You've completely perverted, subverted, foreclosed on finance as a function, and turned it into, mutilated it and turned it into feeding all your savings to the government.
Well, and I think I put something seemingly as benign as banning short selling or curtailing short selling. It's not just on the slippery slope to that. I think it's a big part of that. It's government getting in the middle of markets. It's making them far less efficient, tremendous, like practical loss, but divorcing them ultimately from reality. Now, you mentioned your experience with gold, and you're a gold expert, obviously, among many other things. Free trade is a great donation. He wants to ask you, gold bugs often complain about manipulation of the price of gold and silver. Is there any truth to this, or is that just another conspiracy theory? I've heard that for years too.
I think I have the distinction as being the guy who has written more to debunk this conspiracy theory than anybody. I used to have a real sort of piss and vinegar, attitude. I was putting out articles, maybe not every week, but quite a number of them from say 2010 through, 2017, 2018, when I was like, okay, I think I've kicked that dead horse to death enough times. Anybody's interested in that should look up my article. So there's a guy named Ted Butler who was probably ground zero for this, particularly for silver manipulation. They always talked about silver. He was buddies with the gold manipulation conspiracy guys, but he was a silver guy. He wrote this article basically saying, look, I'm old, I'm retired, I'm an emeritus guy now. I've contributed my body of work. I've helped people understand the manipulation. And anybody who has any disagreement with me, any thoughtful disagreement, I welcome, the criticism in the comments. So I wrote an article called Thoughtful Disagreement with Ted Butler. That's on monetary-metals.com. I noticed somebody had a question about that. You can Google it, Thoughtful Disagreement with Ted Butler. That article went a lot of places. Monetary Metals is probably the best place to see it. It's unadulterated there. And I said, okay, there's two competing theories as to whether the markets are manipulated or, as I contend, the banks are arbitrageurs, not manipulators and not speculators. The banks are not taking a directional bet; they're arbitraging a spread. Right? They buy spot, they sell forward. There's a spread between the two. Not a big one, but if you can borrow billions of dollars and that scales up, you can make a living doing that anyway. You have two theories that are opposite. What does science do when there are two scientists that have different theories? Is they look for a corner case where the two theories predict opposite outcomes. So suppose in astrophysics, Einstein says we're going to find a super duper magnetic pulsing quasar thingy, and light is going to bend to the left. And suppose, or his theory would predict that light would bend to the left. And suppose Lorentz competing theory says light would bend to the right. Then all of physics is sitting on the edge of their seat, waiting for somebody to build a telescope big enough to find one of these objects. And then they peer through the lens and they study the images they get. And eventually it's, light is bending to the left. Einstein has vindicated, Lorentz is in the ash heap of history. And that's how science advances, with these sort of, foundational questions. So I propose a corner case, and I don't want to give it away here. I want people to read the article because we published a great deal of data that we're kind of the sole source of the data for this. But I found a corner case where we'll call it the conspiracy or manipulation theory predicts something's going to happen in one direction, and the Keith Weiner theory, the arbitrage theory, predicts something's going to happen in the opposite direction. I found the data for every futures contract for the entire data series that we've been able to get, licensed from Thomson Reuters, now Refinitiv, with sub-millisecond, every bid and offer going back to 1996 with sub-millisecond resolution to look at this in very high frequency and say, okay, we now have 130 some odd futures contracts. Let's overlay them in this one case and see how they behave. And definitively, they behave this way. This should be case closed against the.
We have the article in our chat, and I want to read it because it kind of, to circle back to where we started. I mean, people are accusing these short sellers of artificially pushing down the price of silver, gold, or bank stocks or anything else. But my sense is, you present, as you said, a different theory, and a more rational theory that includes welcoming short selling as a part of a natural functioning, successful marketplace. And I think objectivists are probably among the only out there who actually see not just a practical value in short selling, but an actual moral value as well.
I was saying one other thing, particularly with gold. I used to say, people have been accumulating gold without any apparent limit for 5,000 years. There's no other commodity that, you'd have a glut very quickly if there was wheat or even copper, or even something durable like copper, iron ore. You can't just accumulate without limit. I say used to because I came across an article where they found some wealthy warrior king or something like that in Bulgaria that dates to 6,500 years ago. And he was buried with like 6 kilos worth of gold, scepter and jewelry and all kinds of other ornamentation. People have been valuing gold and accumulating it for 6,500 years, so far as we know, maybe even longer than that. Of all the markets to think that one could manipulate, if you had a spectrum ranging from some altcoin in the crypto community just introduced yesterday to gold on the opposite extreme, gold would be the last thing in the world that anybody should think of manipulate. There's billions of people in the world who own it, and billions more that are thinking of bidding on it. You'd never be able to move. That is, the biggest aircraft carrier ever, and you think you're going to row out there in your little rowboat and push on it and make that boat budge. No way.
Well, and I know you'd recommend Miss Rand's commentary on gold and capitalism, the unknown ideal. I know it's been influenced. Keith, for those who are late in joining us today, Keith is CEO at Monetary Metals. Really fascinating, all of what Keith does. So visit the website in terms of just exploiting gold, using gold, integrating gold into the world of the ecosystem in a really innovative way. So, and Keith, you use your philosophy in a lot of what you do in terms of your business. Your objectivism is, I don't want to put words in your mouth, but it seems like it's kind of front and center in a lot of what you do professionally.
Yeah, I've tried to find that right. I hate to say balance because it's not really tension or it's not really competing forces. I don't promote objectivism per se. And in fact, I get some flack from some objectivists that I should be more, when I write economics articles, I try to write mostly about the mechanics of what's going on, which unfortunately too much is just pathology. it's like there's a cancer cell and I'm the pathologist looking at it under the slide saying, yep, you see this structure was broken through this wall and, that kind of stuff. But, the idea of rationality, the idea that there is one reality that we can either study or not, the idea of freedom and free markets. My dissertation, I proved that every kind of government intrusion, whether it's setting a price floor, a price ceiling, a tax, this or that, the other thing, and I went through a dozen different cases, and I used I used the calculus of spreads. It wasn't a moral argument. I was just looking at spreads and saying, every time the government intrudes, they always promise improved outcomes, right? That's why people vote for this stuff. They think it's going to make things better. And yet every time they do it, they are interfering with the ability of people to coordinate productively in the economy. They've actually made things worse. And I define my terms and I show my measurements, and this is, so, but, in terms of building a for-profit business, you don't have the time and the money to evangelize. I mean, even buying gold, we did all the soul searching that you have to do when you're going to go to market and you do your marketing plan. There's no way that you can evangelize something. You don't have enough time, you don't have enough money. You have to get traction, you have to find something that's going to work, find a customer who's willing to, wants to pay you now to do what you do now. And so in that sense, we're not promoting objectivism, but the idea is that the world has veered in this horrible direction, particularly in 1913 by creating a central bank, by creating the Fed, and that the world has to rediscover a free market and money, not gold rammed down people's throats by a price fixing scheme, which is what I think most people assume a gold standard would be. Oh, just have the Fed declare the dollar is going to be $2,000 an ounce or whatever. But an actual free market, which is so radical a notion that people can't even imagine what that would look like today. And, my idea was you can do this as a bottom-up entrepreneurial effort rather than trying to lobby government for the perfect gold launch. It'll never happen. You can do this as a bottom-up entrepreneurial effort. And so I was on Amy Peikoff and James Stephen Valiant. I don't know if they still do, but they had a podcast for a while. And they interviewed me, and I was talking about this idea that I think objectivism, that there should be 1,000 objectivist entrepreneurs, each looking at a particular aspect of this system that we're in and why it's so unfree. And each, as Alex Epstein did, found a for-profit business model to solve the problem and make money doing so. And I think there's any number of other possibilities. Amy at that time was working on building a, sort of a privacy-oriented, for-profit business. And at that time I was saying, okay, I'm working on building this idea of monetary metals. Now, since then, we've grown a lot, gotten a lot of traction, and so it's a little bit less front and center. The idea we're changing the world, and a bit more of blocking, attacking, and tackling in Business 101. The next deal and the next press release and the next whatever. But it's, building a business specifically designed to attack, the inefficiency side, the fact that the government has interfered with productive people and their ability to coordinate. And then if you can find an end run or some way around that, you have to stay legal. I mean, you have to lawyer up and do this the right way. But if you can find a way to enable people to coordinate, and what I'm referring to here is, on the one hand, you have all these people that own this gold, and they're paying for storage. Gold has a carry cost, which makes it profoundly unattractive. Most sophisticated people turn their noses up at it. They don't want to own an asset that costs, and then, well, maybe the price is going to go up. They want to own assets that pay a positive return, and hopefully the price goes up. On the one hand, you have all these people that are paying for storage, and the storage is expensive. I mean, it's like 0.75 percentage point per year. After 10 or 20 years, that adds up. Or GLD, which is 40 basis points a year. But you look at how much gold is per share of GLD, it's dripping. It's like you have a tank of water, but every day there's a drop leaking out of it. And on the other hand, you have all these businesses that should be financing in gold, and they're not. And like any business, you think of Uber, you think of eBay, you're just simply bringing two parties together that have a reason to be doing business profitably together, but there isn't a way to coordinate. As you say, you want to sell your house, there isn't all these bids. You want to sell your shares of Apple, there's too many bids. Even I don't know how thousands, hundreds of thousands of bids would be sitting there. And we're doing that for.
Let me ask you a question. Free trade is a question. Well, another question. Would it be practical to transition the US dollar to a gold standard, or would you have to scrap the dollar and start over? If yes, how would you do it?
That's actually neither. So a gold redeemable currency, every unit of that currency begins life by somebody depositing gold into the issuer's institution and getting the piece of paper in return because they trust them. Today, all the dollars that are out there were issued irredeemably. Nobody asked anybody if they trusted anybody. There's no gold deposit there. You can't retroactively say, now the government is going to allow you to redeem your deposit. You didn't make a deposit in the first place. And so the government's credit is irredeemable. It is what it is. Scrapping it is, of course, first of all, going to be politically impossible, but also economically impossible. I mean, if you just wipe out the dollar, that wipes out everybody's savings, everybody's job because their employer is wiped out. I mean, that would just be, a calamity of 476 AD level proportions. What you need to do is have a graceful transition. And so I wrote an article on this, which I submitted to the Wolfson Prize. I didn't win. I knew I wasn't going to win, but I felt it was an exercise worth doing anyway, called Using Gold Bonds to Avert Avert Armageddon. I don't know if I said financial Armageddon, but you can Google that, or if you can put that in the chat, that would be helpful. That's on keithweinereconomics.com. That's my personal page. And the idea is basically that you have to start using gold as in finance, not gold to buy it and its price goes up and then you sell it to get more dollars. The whole point of owning the gold is you think the dollar is unsound in some way and it's failing. So you buy gold, but then something funny happens along the way and that you cheer for its price to go up in terms of the very currency you just said was failing and going to be worthless by tomorrow morning. So you have to start using gold as finance when the debtors now are obligated to pay gold rather than by paying dollars. A couple of things happen, but one of which is that gold is replaced, the debt that's denominated in dollars is being replaced bit by bit with debt denominated in gold. So the dollar can gracefully go away with a firm bid under it and not just disappear catastrophically, number one. And number two, you get gold circulating. And the circulation happens because you're paying interest on the gold. And that was the economic thesis when I used to give economic lectures that talk about the interest rate is the regulator flow in gold. That became the business thesis. We're going to build a company whose raison d'etre is we're going to pay interest on gold, which is going to cause people to bring the gold out into the market where it can, finance something productive. It's not a self-referential, dare I say, Ponzi scheme like what happened in crypto, where, Celsius, but everybody else was doing the same thing. They're borrowing the crypto, promising these absurdly high interest rates, promising, of course, no risk. And what were they doing? Ultimately, they were buying more crypto.
Right, and back with more crypto. There's no actual asset at the end of that chain.
Right, and so when the whole thing eventually collapsed, as it had to, and the regulators, the lawsuits, everything starts. When that happens, you have to be financing productive things in the real world, and if you can do that, then you bring gold back into circulation. You replace the dollar debt with gold debts, and of course, gold has a very different economic behavior. If I owe you $1,000, and I say, here's a $1,000 bill. This is a business card, but pretend it's a $1,000 bill, which doesn't exist anymore anyway. Pretend it's $50, $20 bills. The debt is not extinguished. I get out of the debt loop. I mean, I'm all good with you. We're square. But now you have these pieces of paper that say Federal Reserve note on them, and note means credit. So now the Fed owes you the money. You deposit those in your bank. You're not going to want to be running around with $1,000 in your pocket, probably. Now the bank owes you the money, and the Fed owes the bank. Then what does the bank do? Well, they buy treasury bonds. Now the treasury owes the bank owes you. So we're pushing the lump under the rug. You can never actually get rid of it. But if I owe you, instead of $1,000, I owe you, I guess, half an ounce of gold, and I hand you a half-ounce gold coin, the debt is extinguished. And that's really, really important because it means the debt doesn't have to grow exponentially in the dollar. The debt has to grow exponentially, and it does. And that should be worrying to everybody as you look at $31 trillion just in federal government debt. And that's only the portion of their debt that they admit to. They keep their books in such a way that any private company that did that, officers would be going to prison. And there's all the state government debt, county government debt, city government debt, municipal water district government debt, and then corporate debt, business debt, student loans, home loans, car loans, credit card. The amount of debt that's stacked up here is unpayable. There's no way that it can be paid, and that's headed to, disaster.
I want to definitely get you back to talk about not only your business, but kind of perspectives on gold and sound finance, et cetera. But thank you, Keith, so much. And Keith Weiner, again, Monetary Metals, longtime objectivist. And check out some of these articles as well. I know I've seen them at your website and would really recommend them. So thank you again, Keith, truly for being with us today.
Thanks for having me.
And Bonnie is a big fan as well. Bonnie Bertrand, thank you for your contribution. And become a member of what we're doing here. As I said, you're part of history's largest group of students of objectivism from around the world. And if you hit us up with like 20 shekels a month, I don't know, Keith, what's the shekel market like? We're going to get a quote on that. Saturday at 4 p.m. UK, The History of Astronomy with Jonathan Debunking. That's for ARCUK members only. But again, it's like 20 pounds a month. You get fascinating lectures, fascinating discussion groups. And then Sunday at 3:30 UK, it's History of Philosophy study group with James Valiant, who I think is brilliant on these issues. Again, for ARCUK members, the session will also be live streamed for YouTube members. So become a part of what we're doing here. We're bringing you experts like Keith. We're bringing you experts like James, Harry Binswanger, and we're only doing with your support. Thank you, Christopher. Thank you, Bonnie. Thank you, all of our super chatters and super members. Jonathan Hoenig, on behalf of Keith and Daniel in the booth, thank you for being with us this week. And we'll be seeing you this weekend for our special member events, and see you back here next week for the Daily Objective. We're wishing you best premises. Be well.